Now there are two different ways to calculate cash from operations: the indirect and the direct method. Now these two methods will get you the same answer every time, but they differ in their method. The indirect method is the most commonly used method. It actually starts with net income and adds back non-cash transactions. For example, let's say that I sold $100 worth of t-shirts to Walmart last year. Out of that $100, $50 of that was on credit to Walmart. They're going to pay me eventually. See, my net income would be, let's say, the $100 in profits I made from selling those t-shirts. But according to cash, I really only received $50 of that $100 in cash. So how cash flow from operations would work in the indirect method is I would start with my $100 in profit that I got from selling my t-shirts, and I would actually subtract that $50 in AR, accounts receivable, that we talked about earlier, from that balance to get my new cash from operations of $50. Now it's a bit complicated, and I promise you it even gets a little bit worse here. But I just want to make sure you understand that the indirect method always begins with net income. That's a key difference between them and the direct method. You see, the indirect method really cares about changes to the balance sheet, and specifically which way, up or down, assets and liabilities change. Now the easy rule of thumb here is that if an asset account has increased, you've spent cash or you've recorded revenue that you have not got cash for yet. For example, if I bought a ton of inventory and my inventory account went up, I spent cash to get that inventory. The same thing with accounts receivable. If my accounts receivable went up, that means that people owe me money, but they have not paid me money that I have recorded as a sale already. So anytime that an asset account goes up, you subtract that difference from net income. The complete opposite is true for liabilities. You see, anytime a liability goes up, it means that you owe somebody else money. And because of that, you actually kept a little bit of cash for yourself and you didn't give it to them. So if you see a liability such as a loan or accounts payable increase, that means that you have more cash than your income statement says you do. So if that's the case, you actually add that cash back to your net income. Now I know that's confusing, so let's go through one more example. Let's say once again, I'm a t-shirt company, and this time I actually bought all my t-shirts without the logos printed on them yet from a supplier, and I owe them money. Now, I already sold these t-shirts to Walmart like we talked about earlier, and let's say that I owe my supplier $20 more this time than I did last time. Well, you see, that $20 difference and increase in accounts payable, because I owe them money, which is a liability, would be added back to that $50 in cash we figured out in that previous example. So let's do the math real fast. We have $100 in total profit from my t-shirt company. However, Walmart hasn't paid me half of that already. So I'm going to take out that half they have not paid me, which means that they gave me so far $50 in cash. Since they gave me $50 in cash, but I haven't paid my supplier $20, I add that $20 to that $50, and now I end with a cash balance of $70 from operations. Now, the cash flow from operations really only cares about working capital. Remember, working capital is all about your current assets and your current liabilities. There's one aspect that does not come from working capital. That would be depreciation and amortization. Now remember, when we cover depreciation and amortization in both the income statement and the balance sheet, we talked about how it's a little bit of a special account. It's pretty much how you track and expense an item that you've already paid for. Now, if we're looking at the cash outflows and inflows from operations, which is what the cash flow statement tracks, then we actually need to say, oh, well, if I paid cash for that thing a long time ago, depreciation doesn't really matter to cash flow statements. And that's correct. You see, anytime you start with the indirect method, you have net income and you immediately add back depreciation and amortization. That's because it didn't actually cost you any cash. No cash changes hands when a depreciation is expensed. That's the first item that's always added back when you start the indirect method. Following depreciation and amortization, you then look at the changes to the current assets and current liabilities. Remember, if assets go up, it's negative cash flow. If liabilities go up, it is positive cash flow. Recapping the indirect method for cash flows from operations. You start with net income every time. Then you add back depreciation and amortization. You'd find that on the income statement. Then you subtract any growth in assets that you might have had. Remember, just current assets, like accounts receivable, inventory, things like that. Then you add any growth in liabilities, just current liabilities though, like accounts payable. And that's how you find cash flows from operations using the indirect method.